Hey everyone, welcome to another episode of AdMail. This is Adam Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial.
Hey everyone, Adam Bergman here, tax attorney, and welcome to another episode of AdMail. This is going to be a fun episode, so buckle up. This will, I think, give you a wide variety of information on various topics. And the three questions, the first one involves SEP IRAs and the Roth component. Next one is, how do you make mega deduction contributions to a 401k above 100k? Is it possible? And the third is a self-directed IRA LLC. How is it taxed as a partnership, S corp, discarded entity, and how does all that work? So, really think this is going to be a superbly interesting and hopefully fun episode. Pretty short, gonna be under 7 to 10 minutes. So buckle up. I think you'll learn a lot in the next couple minutes. So here we go. Without further ado, first question from YouTube. And here it is. The company I work for is a SEP IRA. Do they have to offer the Roth option? So the quick answer is no. Starting in the 2023, thanks to Secure Act 2.0, SEP IRAs are allowed to offer profit sharing contributions in Roth. However, the employer does not have to offer that option. If it does offer the option, then the contributions, which can go anywhere from technically 0 to 20% for a sole proprietor single member LLC, or 0 to 25% for a corp with W-2 employees, that can be done generally in pre-tax, and now starting in 2023 in Roth. The way the Roth works is that the contribution is made on behalf of the employee by the employer. The employer still gets a tax deduction, but the employee has to take into account an income, the amount of the contribution, because it's an after-tax account. So that means they have to take it into income first. So it started in 23. I don't think it's really taken off in popularity yet, just because I think when people realize that they have to take into account the income, if it's a Roth contribution versus if it's pre-tax, it's just put into their IRA without tax. There's less interest on the part of the employee, but bottom line is you can't force your employer to offer it. If they offer it, great. If they don't, you can request, but they don't have to. Next question is from who's this? Next question is from Bruce T of Palm Springs, California. Bruce wants to know: I am 55 years old and maxed out my solo 401k plan in 23 and expect to max out again in 24. I'd love to put away 100,000 plus into a plan. Are there any other good options for me? So basically, because you're over 50 years old, the max in 2023 was 73.5. The max in 24 76.5. So if you want to do over 100, there's only one way to do it. And that's something called a defined benefit combo cash balance plan. And I work with two, probably the most prestigious pension companies in the country, been around really for over 40 years. Yeah, literally, but even before ERISA was created. And they specialize in these combo cash balance plans, which are essentially mini defined benefit plans. And based off your age, can allow you to go up to $300,000 in deductions. And if structured properly, only required to make minimal contributions for your employees. You generally need to have, pretty much guaranteed income for 3 of the 5 years. So the plan's supposed to be open for at least 3 to 5 years. So it can't just be a situation where you got 1 year of good income. It's got to be for the next 3 or so years. Generally works if you're over your at least 50 plus, because you can put away higher amounts. If you're only in your 20s or 30s, you're going to be probably limited to the 401k contribution amount. But once you're over 50 and heading up to the 60s and 70s, probably go up to 300k a year, assuming you have enough income. And the way it's structured, it's a defined benefit. So depending on the age of your employees, the amount you have to contribute for your employees actually can be quite minimal. So if you're interested, Bruce, let us know. I can put you in touch with one of our benefit professionals, and they can do a whole case study for you and a whole proposal, basically work out exactly how much you can put away based off your income over the next couple of years. You can do traditional investments and also alternatives in the combo cash balance plan. So pretty flexible, but it's really the only plan, Bruce, that's going to let you go above 100K. Since you're already in the 70s in terms of deductions, if you want to go 100 plus, the combo cash balance plan is going to be your only option. I plan on doing more podcast videos about the combo cash balance plan because it's really kind of a hidden, unknown type of retirement plan. But if you can fit into its criteria and you essentially are in the core category where you're above 50, you make good money, you have under 10 employees, it could be really worthwhile. So thank you, Bruce, for that question. Third, final question of today's episode is from Debbie M. of Jupiter, Florida. Debbie wants to know, I have a self-directed IRA LLC with you. Is it treated as an S corporation? So probably not. Why? Because IRAs cannot be S corp shareholders. That's an S corp rule under Section 1361 and 2 of the tax code. It's not an IRA issue. So no, your IRA LLC will not be treated as an S corp. It's going to be treated as a disregarded entity if the only owner is one IRA, and it'll be treated as a partnership if it's owned by 2 or more IRAs. It will not ever be treated as an S corp. Again, IRAs cannot be S corp shareholders, and it would violate the S corp rules. So that's the simple answer, Debbie, but it's a good question. I actually get this a lot. People get confused about S elections and for some reason think the LLC should be an S corp or taxed as an S corp, but it's actually not possible since an IRA cannot be a shareholder of an S corp. That's it. That's today's podcast, short and sweet. I know everyone's just coming off New Year's and probably don't want to spend a lot of time listening to me talk about IRAs and 401ks and self-directed investments. So I'm keeping it short and sweet. I think these are 3 great questions. There's a recap, SEP, IRA, and Roth component. It's an option. It's not required. It's up to the employer to offer it. If you want to have massive deductions above 100K, defined benefit plan, combo cash balance is the best way. And then third, a self-directed IRA LLC is not taxed as an S corp. It's going to be taxed as either single member disregarded entity or a partnership. So that's it. Happy New Year to everyone. Hope everyone had a great New Year. Hope 24 is a great year for everyone. And I look forward to spending a lot of time with all of you folks throughout 24 talking about really cool self-directed matters, whether it's on AdMail, AdBits, or Adam Talks, or whether you're watching videos on our YouTube channel or listening to other podcasts or just reading our blogs that we post every week. I hope you guys enjoy all the content. You definitely need to subscribe to our YouTube channel at IRA Financial, which has tons of great content. And also, don't forget to check out all the podcasts that I drop each week, and you can pick them up Apple, Spotify, or wherever you listen to podcasts. That's it for today's podcast. Have an amazing rest of your day. Take care and ciao. Hope to speak to everyone again next week. Thanks again.